Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of National Bank are climbing today. The lender beat profit estimates in the first quarter with strong results across the board, up about 6.3% right now. The bank's personal and commercial banking income grew by almost 50% from a year earlier, with its recent acquisition of Canadian Western Bank contributing double-digit gains. The Montreal-based company also plans to return more capital to shareholders by repurchasing more shares than ever before. Shares of the Bank of Montreal are rising today. The lender topped estimates on stronger than expected performance at its U.S. operations and its capital markets unit, which benefited from high trading activity. The Montreal-based company says it earned record revenue in each of its operating segments in the latest quarter, adding they saw fee growth in market-driven businesses. Shares of Loblaw are falling today, off by 4.7% right now. Fourth quarter revenue for the grocer missed estimates, while profit came in slightly above expectations. Food, retail, and pharmacy same-store sales were up. However, December sales saw a brief bump due to the holiday season. The results come as high inflation and rising cost of living have led consumers to try and tighten household budgets and save money. And taking a look at the markets, the TSX trading well over 34,000 right now, intraday highs. Let's see if it'll close above 34,000 for the first time ever. It's up about 0.35 for the day. South of the border, everybody in the green down there as well. The S&P 500 up by 0.55, Dow Jones by 0.3 roughly, and the Nasdaq up by nearly a point. Well, for more on today's Canadian bank earnings, we're joined by Christine Dobby of Bloomberg News. And Christine, thanks as always for joining us. You've been focusing on the Bank of Montreal. What did they do today?
Good morning, Roger. Yes, the Bank of Montreal's posting some very good results this morning. They did have record revenue across all of their segments, as you mentioned off the top there. Very strong results in their capital markets business on strong trading revenue. The bank did record about $200 million in severance costs in the quarter, but that had been telegraphed from last quarter. They discussed taking that charge already, so that had already been factored into the analyst estimates. Overall, their net earnings were up about 16% year over year, and you could see that they're making progress on their return on equity improvement, which has been a big focus for the bank. And so you see investors reacting pretty well to these results this morning.
All right. And they've been trying to improve their results at the U.S. business. How did that turn out?
Yes, this has been a big focus for them as they work towards improving return on equity, as I said, across the whole bank. ROE in the U.S. bank is a lot lower. What they've been doing is they call it optimizing, and they've been selling some of the branches in the United States, as well as selling some of their less lucrative loan portfolios. Executives today talked about having sold off about $6 billion worth of loan assets over the past 4 quarters. And they suggested that they're about 90% done with that process, and that once they are finished with that process, that you'll see loan growth start to accelerate in the U.S. business, and ideally some return on equity improvements would follow as well.
All right. And outlook on credit, how's that shaping up?
Yes, the perennial question, the credit outlook, a bit of a mixed bag here. Stronger growth in the U.S., macroeconomic growth, is sort of balancing out a weaker, more uncertain picture in Canada. So BMO's provisions for potential credit losses came in a bit lower than expected, and they're not expecting any huge increase over the year. But there is, there are some pockets of weakness, particularly among the Canadian consumer, lower income Canadian consumers. One area that they did call out was the GTA, where unemployment has been a bit higher. That's something that we heard from Scotiabank yesterday as well. So something to keep an eye on for sure.
Okay, we'll leave it there. But Christine, thanks as always for the update. Christine Dobby of Bloomberg News. Coming up, we'll get some investor perspective on those results from the Bank of Montreal and National. Stay tuned. Shares of Bank of Montreal are trading higher after the company posted a beat on its American operations and capital markets units. Our next guest says he would hold the BMO stock because while earnings were good, the stock has seen strong gains in the past year, and he thinks the valuations are starting to get a bit stretched. Here to tell us more is Cole Kasher, portfolio manager and senior investment advisor at Wellington Altus Private Wealth. Cole, thanks very much for joining us.
Yeah, thank you for having me.
Initial numbers, your thoughts. What stands out for you? What do you like?
Well, I think the earnings were pretty good across the board. I mean, there wasn't really any major signs of weakness in really any of their divisions. And I think, the banks, as I kind of mentioned in my note, they've performed fairly strongly, but the price is also reflected in the stock now. So, a lot of these companies are seeing a little bit of a bump today. And at some point, the valuation and the numbers just get a little bit stretched where it's going to have to take a breather. But in regards to the current earnings call, I didn't really see a whole lot in there that would be cause for concern. I think your previous guest had mentioned some stuff about the credit, which, that's fair. But obviously, if they're putting less money aside for, credit delinquencies, then that's probably a good thing. So for the most part, these banks have been conservative, and when they have set money aside and they don't end up needing it, it's often results in a dividend increase or some type of capital purchase. So I think the banks seem to be firing on all cylinders, which I think is, to me, it's a little bit surprising because the economy seems a little bit slower. So.
Yeah, that has been the big concern, but then those credit loss numbers kind of offset that. Any potential headwinds that you could see coming for BMO or the other banks?
I don't know of any major headwinds. I think, in the real estate sector, there's some exposure there. You never really know what these banks or really any company has in the financial sphere in relation to private credit exposure. And I know there's been a few cracks in the private credit market over, the last month or two. So I think, sometimes you just don't know what's in Pandora's box. So there's always going to be, some areas that, banks will have exposure to that you maybe hope they wouldn't. But in the long run, a lot of these companies have also proven that they can mitigate and manage risk. And, that's why over, a fairly long track record now for most of the banks, they've delivered pretty good, shareholder returns. So unless, there's something fundamentally broken in, the banking system, which specifically in Canada, I don't think there is, there's not really a major reason why you would see a ton of downside other than the market just rotates out of, banks or, from this sector into something else. And that's just a general, market rotation. And really, there's a lot of good companies that correct and the banks aren't immune to it neither. So to me, it's just more about if I was looking at investing new capital, I think with the run up of the banks, I would probably look elsewhere, but it's not really anything to do with the banks themselves, because I think by and large, they've been very good.
All right. Let's get a couple other names in here. Lowe's, lots of earnings coming out. Lowe's reporting their earnings. And like Home Depot, good, but.
Yeah. Well, and that's the tough part, I think, with some of these companies is you can deliver like what are really good earnings, but, if you don't bump up the guidance or significantly exceed the guidance, then, the stock kind of takes a little bit of a hit. And so with a company like Lowe's, I think that, they've been controlling everything that they can control, which is everything within their stores. They've made some purchases over the last year or two, which I think are helping earnings. They've kind of focused more on, the contractor business as opposed to just the retail customer. And the reality is just, the new home market in the US, it's slow. And so that's just going to be a little bit of a headwind. But in regards to like managing the company and managing risk, I think, Lowe's has actually done a pretty good job. And I think it's, somewhat reflective in the stock price. But when you see, a company sell off fairly substantially just for, what I think are good earnings, but not amazing earnings, then it's just one of those things where, again, sometimes good stocks take a little bit of a breather. And, you might want to identify an entry point of where you'd be comfortable owning it, because I think, Lowe's and its CEO and the execution has been, quite strong.
All right. Another one of those, is this the entry point for Loblaw? They're another good solid earnings, expansion plans, but stock's down.
Exactly. Yeah. And, sometimes the market doesn't like the idea that you have to spend money to make money, whether that's expansion of new stores or in some of the tech companies, like expansion of data centers or build outs and this and that. So I think with Loblaws, it's kind of, the same thing where it's quietly been a very strong performer for like a really long time. And, it's very embedded within Canada and multiple SKUs. So again, I think on a company like Loblaws, like it's not often that, you see, dips of like 10% or 15%, but I think generally if you do, those are areas that you'd probably want to look at accumulating versus, panic selling. So it's something on my watch list right now, where I think somewhere around, current levels in like that 64.50 range, from a technical perspective, it's actually looking pretty good. And if those kind of the 50-day and 200-day moving average hold, then I would think that it actually has a chance to go higher than lower, even though maybe the earnings sell-off came a little bit harder than expected.
All right. We just want to sneak in one more here before we run out of time. Cargojet.
Yeah, Cargojet's interesting because I think in theory, the stock should perform well. The contracts they have, the amount of deliveries, everything as it relates to the stock should be, a stock that performs well. But if you kind of look over not only the last year, but really the last 5 years, it's just kind of been, capital that hasn't really moved. So, I actually don't mind the stock at this level, but it's more so the uncertainty and the trepidation of just owning a stock that really hasn't performed well and not knowing that there's really been anything changing in regards to that. So I think that there's probably better places to deploy capital, but in and itself, the company should be better than what it has been. But sometimes, that's the case where even though you think a stock should be good, it's in the right area, it's got exposure to the right places. That's where execution matters. And, obviously with the 5-year returns on Cargojet, it's hasn't executed. So I think, with the amount of solid management teams, not only in Canada, but the US, you just find, maybe something else that's performed that you have a little bit more trust in.
Okay, Cole, we'll have to wrap it up there, but thank you very much for joining us.
I appreciate it. Thank you.
Cole Catcher is Portfolio Manager and Senior Investment Advisor at Wellington Altus Private Wealth. Coming up, Thomson Reuters saw its biggest intraday gain yesterday since October 2008. We'll get more on what is driving the stock with the company's CEO. That's next. Thomson Reuters shares rose Tuesday, its biggest intraday gain since 2008, after the company said it reached 1 million professional users of CoCounsel, its legal and business artificial intelligence tool. It also announced that it is working with Anthropic's Claude model. For more, we spoke with Steve Hasker, President and CEO of Thomson Reuters.
what we've done is we've created an AI platform for fiduciary professionals. So as you said, lawyers, tax and accounting professionals, auditors. Essentially, we developed it a couple of years ago, and we've developed it in such a way that it is model agnostic. So in other words, we can take the very best enterprise focused foundation model and swap that in. Now, at the moment, in our view, based on our testing, that's Anthropic's Claude suite of models. We have, though, developed our own model called Thomson, which is starting to outperform many of the models specifically for legal. And so it wasn't developed with Anthropic or Claude, but certainly we think their enterprise models are the best at the moment, but we've created some flexibility as we go forward.
I asked that because, of course, the investors were alarmed to hear about Anthropic developing plugins for Claude that could work specifically with lawyers. You have said that where the AI is the biggest change for the legal profession, really, since in the modern era. Tell us why. How will it be so important?
Yeah, I mean, the legal profession, sort of in its current form, I think is probably 3 to 350 years old.
Okay.
You know, it was sort of started in the tea houses in the city of London all those centuries ago, and it sort of fundamentally hasn't changed all that much. Certainly, word processing technology and e-discovery and other things have made some differences, but in our view, this will enable lawyers to be this being AI, will enable lawyers to be very, very significantly more productive. And I think what investors missed with the sort of Anthropic announcements and some of the moves of the foundation models is, at Thomson Reuters, we serve fiduciary professionals. And I think we have to distinguish, and investors, you know, I don't think have done this yet, between sort of knowledge workers, so that's general office workers at one level, professionals, so whether that's salespeople, communications, marketing, architects, whatever it might be, from fiduciaries. Fiduciaries, being lawyers, tax, accounting, audit and the like, have to be right. I mean, the consequences of being wrong are very, very severe for fiduciaries. And what we do is we combine a model like Claude with, I think most importantly, our content. And we've got centuries of curated, highly specialized, very accurate content with deep domain experts, thousands of them, who train our agents. And what it does is it produces results that are fiduciary grade versus results that may be 95% right, which is not acceptable to these fiduciary professionals.
Yeah, I mean, that's the big thing, isn't it? It's got to be right. Although your stock is down by half in the past year. And the market, that's a lot of bright people have been selling the stock. Are they completely wrong?
I think they are. I mean, I think they've missed this point about the quality and the importance of content and expertise to train these agents in this environment. We think we're the only player who can do that effectively and meet or exceed the needs of these fiduciaries. And so we think the investors have missed it, certainly over the last 6 or 7 months, and particularly over the last few weeks.
I have to ask you, and I don't think I'm going to get an answer. The Thomson family of Canada hold a big stake in Thomson Reuters. They have lost tens of billions on paper here. Have you talked to any members of the family?
Yeah, we're in close contact with the family. I mean, bear in mind, in the prior 6 years, the stock rose from $65 up over $200. So net, it's been a positive trajectory over time, and we have every intention of arresting the recent decline and getting back to those levels, and that's what we're laser focused on doing.
You've been on something of a PR campaign this week, or at least you're out there telling the street and the media, hey, we're fighting back here, and this threat is exaggerated, in your view.
It certainly is. And, while we don't like to see this sort of pressure on the stock price, the business continues to perform. And as a team, we are laser focused on getting back to where we think we need to be and deserve to be.
You have this hoard of legal data, and as you say, it goes back centuries. You ingest tens of millions of legal documents every year. So is that proprietary, or can other people get at it?
No, it's proprietary. I mean, essentially what we do is we take many, many different sources, including court records, and all of the sort of case law in jurisdictions across the world. We ingest that, but most importantly, our attorney editors, and we have 2,700 of them on staff, spend all day, every day interpreting those findings, dissenting opinions, figuring out which cases are relevant precedent, which aren't. And then in addition to that, we have many hundreds of practical law editors who are creating the best version of a particular draft, the best clause, the most specific IP for legal practice areas. So sort of that which is publicly available is a starting point, and it's an important starting point, but it really is the value add that our talented staff members add. That's what makes the difference, and that's what delivers the accuracy and the depth of expertise.
You do have competition coming at you, though. LexisNexis, your arch rival, teamed up with a legal startup called Harvey. I know you've said there are frothy valuations in these AI spaces, but you do have competition sniffing around.
Well, we've always had. I think we've always had, formidable competitors that we respect, and we've been able to invest appropriately and outrun them. And so we're, not arrogant about it. This is a moment of disruption, but we're certainly confident in our starting point and the plans we have going forward.
What do you think, broadly, will society be able to get away with fewer lawyers in the future?
Well, the first thing I think is that this sort of tech disruption will be no different than prior, whether that was the sort of steam engine, the combustion engine, factory automation, the internet, cloud, mobile, social. All of these things have created a spike in standards of living, improvements in standard of living, and a spike in legal activity and demand for high-end legal services. So I think the sort of broader addressable market for law firms, for general counsel's offices, goes up, not down. I think the question, which is as yet unanswered, is how much of that demand will be met by the technology, and we're the largest provider of that technology in the world today, and how much will be met with trained lawyers. And I don't think anyone knows that yet. It's too early to tell.
And he was speaking with Steve Hasker, CEO and president of Thomson Reuters. Lowe's shares are under pressure despite a fourth quarter earnings and revenue beat. We'll take a closer look right after the break. U.S. Trade Representative Jamieson Greer says the tariff rate for some countries will go up to 15% or higher from the newly imposed 10%. Greer did not mention any specific trading partners or other details. Greer also said U.S. and Canadian trade officials spoke earlier today and plan to meet in the coming weeks. Reuters is reporting OPEC Plus will likely consider raising its oil output for April. This will mark an end to a 3-month pause in production increases. According to the report, the consideration might come as the group prepares for peak summer demand and tensions between the U.S. and OPEC member Iran boost prices. 8 OPEC Plus producers are scheduled to meet on March 1st. Shares of Circle Internet Group are soaring today, up more than 23%. The American company surpassed revenue expectations for the fourth quarter. Its primary stablecoin, USDC, is seeing a surge in adoption after favorable U.S. regulations. Circulation of USDC rose 72% in the fourth quarter from a year earlier. Circle has also partnered with Visa and prediction market platform Polymarket to push the use of its stablecoin. Quick peek at the markets, and the TSX now well over 34,000, up by nearly a half a point, and a similar rally unfolding down south of the border. Of course, that 34,000 is a record intraday high. South of the border, U.S. markets, S&P 500 up by 0.6, Dow by 0.4, the NASDAQ by a point. Well, Lowe's beat Wall Street expectations in the fourth quarter, with sales surging more than 10% year over year, but shares are falling after the company issued a weaker than expected outlook. Joining us now for some analysis is Stephen Zaccone, Senior Retail Equity Research Analyst at Citi. Stephen, thanks very much for joining us.
Yeah, thanks for having me on.
Kind of deja vu all over again compared to Home Depot. Decent numbers, but it's that outlook that has people worried.
Yeah, deja vu. It's a fair way to think about it. I think when you look at 2026, right, it's very much a year of gradual improvement in the home improvement backdrop, right? The next few years should be better than the last couple of years. You've got consumer uncertainty. You've got a frozen housing market here in the United States. All of those are kind of overhangs. We'd love to see some better growth for the category overall, but we're still in this sort of environment where, we're slight growth is kind of the new normal for home improvement, right? Rates coming down would be a definite tailwind, but until that really happens or you see housing turnover pick up, slight growth is probably the new normal for home improvement.
Did the pandemic skew expectations? Has that been a factor, or are we past that and these are different factors for it?
I think we're getting to the later stages of that, right? Like the give back from the pandemic. It's a great question. I think that was really the factor 22, 23, 24, 25. You really saw engagement come back to the home for the existing homeowner. I think the problem you have now is just you've got so many homeowners who are kind of locked in at a certain rate. They're not moving. Existing home sales is really that key metric that we're looking for to drive an increase in large project activity. So think about, flooring, kitchen and bath remodels, right? Some of those big ticket things. You'd love to see that pick up. I think that's really what's the issue right now. The second thing I'd kind of brought up, there was tariffs discussed previously, is I think there is some sticker shock with the U.S. consumer when you think about doing a project, right? Like we have higher cost of building materials, right? Like there's been inflation, tariffs, but just generally speaking, there's been inflation across the economy. I think the second thing, is labor availability, right? It has been a little bit challenged in the United States, and you're seeing some aspects of that in project costs.
And is there a moment, like, are we hitting a pent-up demand where people are going to have to start doing these things, or is this something they could keep putting off if the economy doesn't change?
Yeah, I think we've heard about it for some time, so there's a little fatigue to say there's pent-up demand. There should be, right? You do get to a point where if you get mortgage rates to get below 5.5%, to get below 5%, those people who are kind of at that level in their existing home, or maybe at their 4%, you're willing to only trade up for a little bit to go purchase a new house. So you do feel like you do see the pent up demand out there from turnover. I think when you look at people who are in an existing home, they did do a lot of projects. Right. So you probably need the turnover piece to really see that pent up demand come. Lowe's gave a great data point today, too. We're still underhomed in the U.S. Right. Some of the industry data points to 16 million, housing units need to be built within the next couple of years. So there are tailwinds out there to be positive home improvement on a multi-year or longer term basis. It's just that shape of the recovery has been the most difficult thing to predict the last couple of years.
And now they've been starting to push for the professional contractors. Is that working? And could that be a big benefit if the housing build starts up and starts going gangbusters again?
Yeah, I think it's a great question. And I think it's an aspect of both Depot and Lowe's that's changed the last couple of years. You've seen them do acquisitions to get bigger into this large pro or building material space. And it's really a land grab to go after the dollars. You're in an environment where the housing market's a little bit weaker. So let's go out and buy some assets so we have more capabilities. So on the other side of this, we come out much stronger. I think that's the right strategy long term. The concern for a Lowe's and a Depot is those businesses are a little bit more cyclical and they do carry a little bit lower margins. And I think that's, to bring it back to Lowe's today, you saw that with the initial outlook for 26. You did see some lower margin outlook and earnings below the street. They'll have an analyst day later this year in December. We'll hear a little bit more about the longer term opportunity for Lowe's. Our argument and our house view at Citi, we preferred Home Depot just because they've done a better job kind of integrating the asset, and there's not as much of this kind of margin concerns going forward. So we'll see what Lowe's says later in the year.
And so would you say Home Depot had the better report then?
I mean, we're partial with the buy rating, so I would say so. I think it's important to keep in mind Home Depot had an analyst day in December. They did the heavy lifting in terms of like setting 2026 expectations at that time. So I feel like they set the floor. But if you're looking at the 2 days today, it seems like Depot had the better day.
Okay, and with Lowe's, anything else in the pipes coming down the pipe? They're looking at the professional contractors. They have anything else they're trying to do to build business?
Yeah, I mean, this year, home improvements always dictated by the weather. I'm home for the third day in a row here because we still have more snow in the New York area. So think about, weather impact. We'd love to see spring, a stronger spring this year than we've had the last couple of years. We haven't really seen sort of storm impact. So the fact that we've had a good amount of winter storms, maybe you get some roofing repairs as spring happens, and then you see into the back half of the year, we didn't really have hurricanes in 25. So if you have more, hurricane damage in 2026, that always tends to help the home improvement business. But I'd say that would be the other kind of wild card to think about is like, what's the weather do for demand?
Okay, Steve, we'll wrap it up there, and you can keep the snow. We have enough up here. Thank you.
Yeah, thanks very much.
All right, cheers. Stephen Zaccone is Senior Retail Equity Research Analyst at Citi. Coming up, Canadian banks have begun reporting earnings. We'll break down the numbers for the Bank of Montreal and National when we come back. It is Canadian bank earnings week, and it kicked off with both Bank of Montreal and National Bank beating expectations in their latest quarter. For more, we sat down earlier with Grant White, Portfolio Manager and Investment Advisor at Endeavour Wealth Management.
A big miss for a bank would be a huge, huge miss from a share price perspective. And so it's really nice to see that the banks are continuing to chug along this week, obviously, with BMO and National Bank continuing that trend that we saw earlier in the week. And yeah, they've done very well here on these reports. It is expected. We expect them to do this incremental growth. But it's nice to see that come through.
And it must get harder and harder. Let's talk about Bank of Montreal first. What are the numbers that stand out for you? Which ones do you like?
I love to see the loan loss provisions coming down. I mean, I think that's obviously that's heading in the right direction. And so every year that we see that going on, every quarter that we see that going on, that's really great, obviously. And it shows that good management is continuing on. But, Bank of Montreal, just what I love about them today is the diversified portfolio of revenue that's coming in for them. And we're seeing it from diversified aspects of the business. And so, that's why we've got BMO actually as our top buy from the Canadian banks right now, because from a pricing perspective, we're it's looking really strong, but we're getting diversified revenues from multiple streams. And that gives us a lot of confidence about the bank going forward.
And any concerns about those streams?
No, not right now. I mean, I think that's the key to diversity, though, right? I mean, if there is any concerns that come up, we're still going to be looking strong in most areas in the bank there. So we feel really good about BMO right now. I think they're going to continue to chug along. Again, this is a core portfolio holding, so it's not like we're not hitting grand slams here. We're looking at 7 to 8% per year over the next few years is our expectation on that.
It's an expectation. Now they said they want to go out. They want to leave 2027 with a return on investment. A return on earnings 15% there, I think at 12.4. Is that achievable?
I think it's achievable. I think the stars need to align a little bit, but it's one of those where if they come a little bit short on that, we're still very happy with the company and the holding. But yeah, I think it's achievable. I mean, good management. They've done a great job over the last few years. I mean, this isn't like a one-off report here. We've seen this consistently over the last few years from them. So it's achievable. I think it's going to be a bit of a stretch, but we'll see.
What would some of the stars have to align? What would some of those stars be?
Well, I think like the loan loss provisions still have to come down. I think there's economic factors that they still have to play out for them. The American economy, I mean, we're seeing good revenue coming out of the U.S. holdings. And so I think the American economy continuing to push along will help that. So if all of those things continue to come together, if they continue to maintain good momentum here in Canada as well, then I think things could look good.
And with those Scotiabank was up yesterday, their loan loss provisions, was it not?
Yeah, I think it was up a little bit, yeah.
Any idea on the differences between the two, the reasons why?
Scotia is on the other side of our holding, of our buy rating, actually. So they would be the least likely to get a buy from us at this point. And a lot of that has to do with like the Latin American holdings. And yeah, they've got diversity there, but it's just not diversity that's really working out for them. On the loan loss provisions side of things, I didn't dive too deep into the details of it, to be honest, with Scotia. But what I am noticing out of BMO is just continued strength, and that's a continuing trend going forward and forward. So as of right now, we like BMO a whole lot more. And like I said, Scotia's on the other side of it.
Okay, and then is National in the middle? Where does National fit in? What do you
Actually, you know, it's a great day to have me here because National Bank's number 2 on our list.
There you go.
So National, I mean, this is the bank that I keep expecting is going to slow up at some point. Being such a regional player, you know, in Quebec, obviously, I keep thinking that that's going to hold them back. But they have such great management. They have had for a long time. Here's one thing that I really like about them. So they just announced that they're going to increase their share buybacks again. If you add up their share buybacks with their dividend yield, you're basically looking at a yield of about 6% on this company. So 6%, that's really stable and consistent. That's really hard to find today. And that's what you're getting on a National. So you're getting a 6% yield, basically. You've got good growth opportunities, but really, I don't need them to grow that much. I just need them to kind of chug along. Yeah. And if they do a little bit, you know, 3 to 4% per year on the revenue side, we're getting an 8, 9, 10% return on this company. So, you know, they're doing a really great job. I love their discipline at National Bank. And for all those reasons, you know, we've got them as number 2 on the list.
And where are those growth opportunities? Are they running out? I mean, there's only so much of a market in Canada for banks. Are they running out?
I don't think they're running out. I mean, you've seen the acquisitions they've done over the last few years with, you know, Canadian Western, Laurentian. I think there's more opportunities out there for them. I think what's going to be really critical for them is the integration of those businesses. They've done a good job at that over the last year. And as we go forward, I'd like to see how they realize the growth out of those acquisitions that they've already done. So I think actually for National, they've probably got one of the best domestic growth opportunities out of any of the banks. And those acquisitions are absolutely going to fuel those for them. So.
And how would you like to see them try and grow it? What would you like to see them do?
Well, as of right now, realize the opportunities in Canadian Western properties that they bought, realize the opportunity in Laurentian, and integrate that very well. You know, they're seeing, I mean, from the commercial lending side of things, you know, we're seeing this back home in Winnipeg. There's a big office there, and they've been pushing a lot more into the prairie. So I think there's like these regional stories that they're going to take advantage of. They're becoming a much more of a household name across the country. So for those reasons, I mean, actually, I think they could be a dark horse in the domestic game. So I think they've got a lot more growth opportunity domestically than a lot of the other banks actually have. They're already there. You know,
all right.
So.
And we're almost out of time, but quickly, what are you expecting with who's left? RBC's left. I'm trying to think who else is left.
I think
here.
Royals tomorrow.
Yeah, the rest are tomorrow.
Yeah. So. I expect they're going to look consistent. Royal is number 3 on our list. We've owned Royal for a long time as well. I would expect Royal's going to look good again for a lot of the reasons I like BMO. You know, we'll see how the rest of them play out. But I think they're going to look fairly strong based on what we've seen so far.
Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Coming up, Denison Mines announces its final movement on the uranium project, its unique latest uranium project. We'll hear more from their CEO after this. Denison Mines has made its final investment decision for a new uranium mine in northern Saskatchewan. Construction is expected to begin next month and wrap up within 2 years. Let's get more on this from David Cates, President and CEO of Denison Mines. And David, thanks very much for joining us.
My pleasure to be here. It's an incredible milestone for our company and the Canadian uranium sector right now.
What made you make the decision today? What was the final reason?
Yeah, look, we've been advancing this project diligently for several years, and the project has been construction ready since the beginning of this year. The remaining hurdle was federal approval by the Canadian Nuclear Safety Commission, which we received for the construction of our project last week. And so it didn't take us long to make that definitive decision. We've been working towards this again for some time, and with those approvals in hand and our team organized, we're ready to start construction next month.
And now things started on this in 2019. The permitting effort started in 2019. It'll be almost in 9 years, essentially, by the time it starts operating, hopefully, if everything goes well. Is there any way that could have been sped up or done faster?
Well, look, the resource development is a deposit that we'll be mining. The Phoenix deposit, incredibly grade, was discovered in 2000. And so...
Sorry, sorry, David, I don't mean to interrupt, but we had a little bit of technical difficulty. If you could just repeat that there. We just had you cut out there for a second.
Yeah, no worries. My apologies. Look, the deposit was discovered in 2008, and it took us several years to delineate it and bring it to the point where we could make a permitting decision or commence permitting. From then, it has taken some time. Certainly, the pandemic slowed us down a little bit on our permitting and engagement activities, but it has been a long road to get the permitting approved. Could it have gone faster? By nature, our business is a long-term business, so people have to expect long timelines for resource development projects. I think the provincial permitting process is a good guide. We were able to obtain our provincial approvals earlier than our federal approvals, and there absolutely are ways in which the process could move faster. But what we do have on the back of this approval is a very rigorous regulatory review process that validates that our project can be developed safely and sustainably, and will be well regulated. And some of our customers really value that. You know, our customers will be nuclear utilities. They're accustomed to strict regulation, and they choose to buy uranium from Canada because they know that Canadian uranium is coming from a mine that's well regulated.
All right, and you're doing ISR, which is in situ recovery. First time in Canada. What is that, and why is it different?
Yeah, it's a very common mining method for uranium globally. Over half the world's uranium production will come from ISR mining. Essentially, it's a mining method that uses a series of near vertical borehole wells to introduce a mining solution into the ore body at depth. In our case, we're about 400 meters down. We'll use a sulfuric acid-based solution. While it's traveling through the natural host rock that's permeable, it'll dissolve the uranium, and then using another recovery well, we'll pump that dissolved uranium up to surface. And on surface, it'll be processed in a process plant. What's unique about it is that we're not excavating a rock. So we will not have conventional tailings, which is a major sustainability advantage and a cost advantage. Our process plant is simple. We don't have to crush, grind, or handle ores. We don't have to leach. We don't have to go through SX or IX-like process circuits. We can have a very simple on-surface plant. And what that results in for us is a very low-cost mining method that generates very high margins. And because we're not sinking a shaft or opening a pit or building a big mill, we also have very low CapEx, and we've just updated our CapEx estimate on the project. It's around $600 million Canadian from this post-FID point, which will be, $1 to $2 billion lower cost than if we were to build a greenfield conventional underground mine in the region.
And any environmental concerns with this? I mean, this is the first time in Canada. Why are we only doing it now if it's so common elsewhere?
Yeah, the geologic setting we have is not exactly textbook to the world's standard of ISR mining, but over the last 6 years, we've proven through diligent technical evaluations, field tests from our team in Saskatoon, they've proven that the ore body is amenable to ISR mining. We are certainly aware of the fact that this is a first of its kind operation, and we have gone above and beyond in the de-risking work as well as the environmental assessments around the project. And so we are absolutely confident that we can deploy this really tried, tested, true mining method globally to our jurisdiction and be successful. And I do believe it could become the preferred way to mine in the region with our success.
And now, do you have the money in hand for this, or are you going to have to raise more funds?
Yeah, great question. That's a typical sort of hurdle for a developer, but we've made the FID decision with our project being fully funded. We have, at the end of the third quarter of 2025, we had over $700 million in cash, physical uranium, and investments on our balance sheet. So that $600 million initial capital price tag is taken care of. Our company is in very strong financial position, and we are funded to execute the project.
All right, and has everything been on schedule? Just one last quick question. Everything been on schedule, and does it look like it's going to be ready to open in 28?
Yeah, look, the permitting timeline, ultimate approvals came in the window that we needed it to come in for us to hit on our construction schedule that we've developed. We have built that construction schedule to an advanced stage where we are ready to start construction, as you know, next month. Obviously, building a new mine comes with risks, but at this stage, it looks like we are in good shape to be able to deliver on our timelines and be producing by the middle of 2028. And Roger, what's interesting about that last point maybe is there are very few, if any, new sources of uranium supply coming to the market before the 2030s.
Okay, David, we have to wrap it up there, but thank you very much for joining us.
Appreciate it.
David Cates is president and CEO of Denison Mines. Well, Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions to knowyouroptions@bnnbloomberg.ca. Market Call is coming up next. Today on the show, we have Darren Sissons. He's partner and portfolio manager at Campbell, Lee & Ross Investment Management. He'll be taking your questions on global and technology stocks. And a quick look at the markets before we go. We'll start on Bay Street, which is well into record territory, having another good day, up 0.68%, above 34,000. Just dropped below 34,200, but intraday highs, and it's shaping up to be a record high close again for the week after Monday's record high close. Taking a look at some of the talkers today, BMO is up first. Its earnings solid today. People reacting to it. Investors liking it, up 4.25. National Bank also reporting today. It's into record high territories right now. It's up 7% for the day, again on a beat for the first quarter. And one other one we want to take a look at, Loblaw has been struggling a little. The low quality fourth quarter beat is how they're describing it. It's off by more than 5%, biggest drop since 2023. All right, quick boo at the Wall Street, and gangbuster day there. Again, you can see the S&P 500 up by 0.7, Dow by 0.5, and the NASDAQ by more than 1. That is it for Morning Markets. Thanks very much for joining us. We'll see you back here tomorrow. Have a great day.